Welcome, everybody, to the Financial Freedom Fighters podcast. I'm your host, Jacob Sandoval. I have with me my co-host, Mike Magno, and we have a very special guest today. He's actually my CPA, and we are going to dive into the all-important world of taxes because it is not how much you make. It is how much you keep. So I would love to introduce Tony, my CPA, aka the CPA Dude on Instagram, creating fire content. Tony, say what's up to the people.
What's up? What's up? Thanks for having me here.
Absolutely. Yeah. Thanks for joining us.
I'm very excited about the value that you're going to be able to deliver to our audience today. And taxes is just one of those things, Tony. And you know this, you live and breathe this, but it's one of the areas that is the least well understood in the real estate investing space. And it's, quote unquote, maybe the least sexy, at least to the beginning investors. But for the people that are doing this at a high level, taxes is all important. So why don't you just introduce yourself, Tony, to our audience and tell us a little bit about the origin story of you and the CPA Dude. And why don't you just jump into that?
Yeah, for sure. Yeah, no, once again, appreciate you having us here. Just, helping spread the message of taxes since they don't teach us in school. But yeah, it started really young. I was 11 years old working at my mom and dad's Chinese restaurant. So, child labor at its finest. Typing up tickets, adding that up. And then that's kind of where the numbers part kind of came in, where it's like, oh, okay, cool. You add up tickets. Favorite thing of the day was, end of the day, counting the cash. So that's where the love of money came through too. So I was just like, man, when I was like sad, my mom would be like, hey, just go count the register. Like you just like count cash and have some fun. So that kind of just snowballed into, she kind of taught me payroll taxes. Like it was like OG before like software came out. It's just, you pull up the table, the book, the person, how much they made, the withholding. So I learned how to do that OG. And then also sales tax, that was like calculated OG style. So everything was like grassroots. So then that kind of just set up the frame, just like, hey, go to college and, probably head towards that direction. But, classic brainwashed Asian, I gotta go be a doctor. Like,
of course,
gotta be a doctor. And yeah, I think I went in first year, University of Minnesota, and I think I got like straight B's or something. And my dad's like, dude, you're doing nothing with this. Like, so he pulled me out. And then I just ran one of his restaurants, bought a restaurant, and I just ran that restaurant. And then did that for like a year and a half. And then my mom was like very big on education. So then she was just like, you got to go back. And I was like, all right, just Asian son, just do whatever mom wants. And then went back. And then at that point, I was like, oh, accounting makes sense. So then did the whole accounting thing, doubled in like information systems just because I like tech. And then did the classic like work at KPMG, brainwashed into that whole spiel. Amazing marketing, amazing pyramid schemes, my friend. So
I was big four too, Tony. I was EY.
Yeah. So you know how it goes. It's like, oh my God, I made it into big four. And then you're like working 80 hours for like 54 grand. I'm like, damn, like, what am I doing?
100%.
So yeah, we had a good coworker. He was just like, dude, I'm pretty sure like how many hours we clock divided by 54 grand, we make less than like minimum wage at McDonald's flipping burgers. And then we're like, yep. Lovely. So yeah, that transpired. And I was just like, all right. And then moved to the Bay in 2017. And then, that 54 grand wasn't going to cut it. So then I just was just like, I need to find some more money just to survive. So then went to a real estate mid-sized firm, Novogradic. And then they were specifically focused on real estate. So that was fun, picked up a lot. And then also I've been kind of just doing my parents' properties, manage all their properties forever since I was like in like college. So just kind of got used to real estate investing, doing all theirs, handling all the management, all that crap. And then, just did Uber, DoorDash, did the whole tech scene. Got to taste some of that while you're out here. I love Kool-Aid apparently. So you go buy into the big four dream, go buy into the tech dream. And then it was just a realization of, this isn't going to cut it. I was working like 12 hours a day, like 6 days a week. And then sometimes they were like, hey, random weekends or nights just get called in. I'm like, damn, there's like no sense of space here. And then I was just like, no, I can't do this. So I started up the firm, went full-time in 2021. So just spun up the firm, CPA Dude. Primarily my fiance thought of it. The logo was her. She drew it up. The name was her. And then it was just very like my personality on brand of like, because like taxes is just like meh, it's boring. Like, how can you translate this layman's terms? Because you'd be like, oh, section 179, section 121, like, oh, that's all great, but I'm like, bro, does anyone know what this means? Like, what does this mean? So my whole thing was just very like KISS, like keep it simple, stupid is my method. And it's like, hey, what's the TLDR? Here you go, get it done, save some money, stay audit ready, and you're good to go. So spun that up in 21. We're up to 4, 5, 6, 7, 8 now. So 8 employees, serving across all 50 states. So I just had a new manager start today. He came from PwC, so suckered another one out of that Big Four scheme. So yeah, we got that going on now. And then primarily the firm's just been built on like client feedback. Just, hey, like slow responses, not helping them save on taxes, not educating them. So in terms of building the firm, it was actually quite easy because they literally told you what they wanted. So we just turned into like a massive like tax advisory firm, really saying, hey, year one, we got to work with you just to fix up your situation. Because normally people think, oh, I go to a CPA, they're going to look out for everything, but they don't. All they're doing is just like preparing your taxes, which is important. You got to do it right. But they're not really looking out in the future. Since tax planning has to happen the current year, it can't really, once the clock struck like 12/31, you're kind of SOL. So that's what we do now. And then just helping folks out, saving money and getting them audit ready. That's been a big focus this past year, just because the 87,000 revenue agent hire, IRS is not pulling money out of their pocket for that, nor is government. So they're definitely going to be just, taking that out of audit money. So that's been getting folks ready on the audit side. So that's been the big thing. And then, yeah, of course, filing taxes. And that's where we've come to today now.
Yeah. Tony, you've had an amazing journey. And I must say that the branding of the CPA Dude was absolutely the reason that I decided to kind of reach out to you, because it's just incredibly confusing and uninspiring when you're kind of stressed out about taxes and you're like, I don't know who to go to, especially when your taxes get a little bit more complicated. And we can talk about the right time to kind of find a legit CPA. But when it's like every single tax firm has the same branding, the same type of like vibe, you're just like, this sucks. And so when I saw the CPA Dude, I was like, okay, this is awesome. So I just have to commend you on the branding. Well, I guess your fiance on the branding, because that definitely stood out to me and was 100% the reason that I decided to kind of reach out to you.
Oh, nice. So awesome. That's great feedback to know. And I'll definitely give her the kudos there for sure.
Amazing. So let's take a step back, Tony. And this is a podcast of people that obviously understand the power of real estate investing. Otherwise, they wouldn't be listening to Mike and I ramble on here every other week. But let's just take a couple steps back. Why should real estate investors or aspiring real estate investors, why should they really care about taxes?
Oh, yeah. So I'd say there's a couple things of why you should care about the taxes and how it relates to real estate. So one, the sad thing is nothing's guaranteed but death and taxes. So you're going to have to pay taxes till you die, sadly. So that's like, hey, it's going to be an expense. It's always going to be a haircut anywhere from, probably, for your listeners, probably well easy 20% plus of everything they make, right? So every $100 you make, 20% is going to be gone at least to the government. So that's number one of like, hey, how can you shield your money from this biggest expense you'll have? So it's always going to be recurring. And we all know time value money calculators, hey, put $100 in the S&P 500, watch it grow over 40 years. Think about the same for your taxes. Pay 10K plus over your, 70 years, if we're going statistically how long you live for. And that's a massive expense. So, well, minus 18, because you probably don't work till you're 18. So 60 years. So that's going to be number one. But number two, for real estate specifically, it's just how the tax code's written. So I always keep it simple and tell folks the tax code's written for real estate, small businesses / business, and charity. If you're not really playing in those three realms, those three sandboxes, you're off the field. You're not even competitive. You're just sitting on the sideline, just waiting for Uncle Sam, reach out his hand in his pocket, take your taxes, and see you next year. So if you're not even playing in the right sandbox, I mean, that's number one issue. So using the code, to your advantage, like what's the one saying? Don't hate the player, hate the game.
Don't hate the player, hate the game. Yeah,
exactly. So if the game's written, for real estate, let's keep it that way. So that's number one, like, hey, which one can you use? And then within those three buckets, actually, it's always those, I would say those are your big three. And then within there, it's like, hey, like deferral and acceleration. Those are your next two parts. If you're like just road mapping it, you better land on one of those maps. And then within that, how can you use those two strategies alone to use it? So real estate side, it's, going into it a little bit more is now that you know that the tax code's written for real estate investors, real estate owners of any sort, it's like, what can you do? And the biggest thing that I think a lot of folks overlook is it's actually tax-free income. No one realizes they want a little bit more. They're always squeezing. I get it. I'm Asian too. I like to squeeze the hell out of everything. It's like, I need double benefit. But, the main thing is it's going to be tax-free income, generally speaking, because of depreciation. And then depreciation is simply put, you don't get it right off your mortgage, but, the principal, of course, but instead it's the tax version of your principal of your mortgage. So using that layered in with strategies of like cost segregation, accelerated depreciation, then bonus depreciation, now you're speeding up the timelines. So that's why, real estate's such a great vehicle. Is just, you're going to get all that rent, got money in the bank, but Uncle Sam's not going to take that 20% again this time. So that's the big part of like, hey, you just got to tap into it and it's going to help you out tremendously. I mean, even if you don't invest, get a home, right? I mean, primary residence, even if you do nothing, 9 to 5, I go home, watch Netflix, at least you'll get property taxes, mortgage interest versus paying rent. So even if you just own it, you're not an investor, that's still great. You're still taking advantage of itemized deductions because, from the tax world, you either take the higher of the standard or itemized. So the only ways you're going to itemize ever since 2018 is if you have a house. Like they pretty much ruled out because the standard deduction is so high. There's no way you're really going to itemize. I always tell folks, either you own a home, you donated like there's no tomorrow, or you had a horrendous medical expense that year. Other than that, ever since 2018, you don't really itemize.
Just take the standard.
Yep, exactly. Like 80%, I think like maybe the report was a little lower, like 75% is really bad because they capped state and local taxes. So us California folks got played. Yeah. Because we all know state and local property taxes is probably easy 10K. Then if you add in your state and local income taxes, anything on top is gone. So that 10K cap really killed you. Unless you own a business, then you can have a pass-through entity tax election. But yeah, it's just, I always say your intro level, just start. But then, because a lot of the tax strategy and planning that we do, sometimes it's just accountability. They'll come to us, high W-2. I'm like, dude, you need a house. Like if you get a short-term rental, great. If not, get a primary. But I always say, if you get a primary, can you live with some strangers and house hack it? Or is the lot big enough, build an ADU? It's always like pushing folks to get more strategic about their taxes and how you can really utilize it. There's so much you can do. Like STR, is great for tax benefits, mom and pop deduction. That's always a big one too. Business owners, grouping elections are great. Like there's just so many angles you can hit it with. It's just which one works for you.
Yeah. So Tony, you just dropped so much amazing knowledge in that brief stint. I want to emphasize a couple of things. So one, you said, don't hate the player, hate the game, which I love that use of the phrase here because a lot of people, they hear really rich people, really wealthy people say, I don't pay taxes. I don't pay taxes. And I think the instinct for a lot of people is to get mad at that, to be like, oh, well, they're taking advantage of the system, et cetera, et cetera. But don't hate the player, hate the game. Tony said it. The government has written the tax code to favor business owners and real estate investors. That just is what it is. And we can get into reasons on why we think that is. But instead of kind of questioning that, just understanding the rules, getting linked up with somebody like Tony, who's not just going to be filing your taxes, but that's going to be helping you strategize to say, hey, let's keep a little bit of this money that you work so hard to make. I work in tech. A lot of you listeners, you probably work in tech as well. And every single year we climb up that rung and we pat ourselves on the back and we say, oh man, we're making multiple six figures and it's amazing. And then you look at the tax bill at the end of the day, you're like, hold on, wait a minute. This is not fun. This is not cool. And so, your reliance on your W-2, this is another thing that I kind of pulled from what Tony is saying. And I think they talk about this in Rich Dad, Poor Dad or Cash Flow Quadrant and things like that. The W-2 is the worst deal from a tax perspective. It's the worst deal. It's the least tax advantage type of income there is. That's just important for you to know. And that's okay if you're in your W-2. I'm still in my W-2 and that's fine. We have to do that. But as you get older, the income that you rely upon, you should be shifting that to more tax advantaged income like real estate, like small business. If you're somebody that makes, let's just say like $100,000 in your W-2 versus let's say you make $100,000 in just rental income from real estate. Those two things from a tax perspective are not going to be the same, in terms of how much of that you're going to keep. And so all this to say, this is a different game and people like Tony are helping you play that game. And if you ignore that game, it is to your detriment, right? Because the rich people are playing this game. So let's not get mad, ladies and gentlemen. Let's play the game and let's let people like Tony help us play the game. So anyway, Tony, I wanted to kind of emphasize that point because I think that was the big aha moment for me was I'm just not playing the right game, and just continuing to climb my way up the corporate ladder and continuing to pay more taxes is not actually, it's not getting me to the end goal in the most efficient way as possible.
Oh yeah, definitely. It's not like it's your fault or anyone's fault. It's education's fault. If I had to point a finger, don't like to point fingers, but I'll point this one at our education system is why was there never a tax course and then never a tax class, in K through 12. And then even, hey, we got electives or like generals that you have to do in college. It's why didn't we teach any of this? It's everyone has to pay taxes. So that's kind of like one big thing that's always like, oh, if they had the knowledge, you would know to do better. So it's like no one's fault. It's like you kind of, after a while, we work so hard, right? Because if you're working 60 hours a week in tech, always on, always never off. And then you're like, wait, 30% of my check's gone every time. It kind of hurts. It adds up. It's like this hamster wheel doesn't stop. It's a great hamster wheel. You keep running, it produces cash, but just the day you stop running, it's done. There's no more cash coming out of it.
100%.
Yeah. So I saw this post the other day and I look at it and I just laugh. It was talking about the taxes, right? It says, everybody's got to pay, I'll paraphrase. Everybody has to pay taxes, but then you have to figure out what you owe them, right? Like you say, okay, well, I have to pay taxes. Well, what do I owe you? Well, we don't know. You have to tell us what you owe us. like really? Like, come on. It's such a ass backwards system. And, I have this conversation with people when they obviously are doing consults with me about investing in our market. And I go through not a lot. I don't go real in depth, obviously, because I'm not a CPA and I can't give advice, but, just giving people the perspectives to look at it, right? Just the little things that they can get, between the depreciation on, a residential property or the mortgage interest. Like people don't think about that. Cash out refinances, right? Like there's another one where, it's a loan. So it's, you don't get taxed on it, right? That's the big Robert Kiyosaki. That's what he always talks about. I've got debt. Right. Wasn't there a quote out recently? I have $1 billion in debt. It had the internet, on fire.
Yep.
All of the non-business, non-real estate people like took that headline and kind of ran with it. And I was in a Barnes and Noble. It's really funny. And I think Robert Kiyosaki is, he's been doomsday for the past 20 years. And I think he's a little bit wacky, and he's an OG in the real estate investing space, obviously because of Rich Dad, Poor Dad. But I was in a Barnes and Noble and somebody was like, the guy who wrote, because we were like right next to Rich Dad, Poor Dad. There's these two random people behind me there. Oh, the guy that wrote Rich Dad, Poor Dad? He's like so much debt. He's terrible with money. Like, I can't believe that people are reading his book. He's terrible with money. And I was just like sitting there and it was early.
Feel like in that debate
in the morning. I didn't feel like getting into a random argument with people in a Barnes and Noble. But this is part of it. Like, there's like a massive gap. To your point, Tony, right? A massive gap in understanding of just the system, right? Yes, Robert Kiyosaki is $1 billion in debt, but he probably has all that debt because it's helped him acquire much more value in assets and it's generating cash flow to service that debt. So that debt is not the same debt as people think of debt.
The missing piece of that headline is the fact that $1 billion in debt is on $3 billion in assets, or some asinine number of even if it's 50% debt, right? He's still got $2 billion in assets. Now, how much cash flow is $2 billion in assets thrown off every month? I mean, come on.
Yeah. So the random Barnes and Noble people, just don't listen to the clickbait articles until you do a little bit of research. So Tony, let's go a little bit deeper on some of the tax concept. We talked a little bit about this, but I think that I'd love for the listeners to kind of understand this. When we say, real estate is the most tax advantaged asset class around, let's get a little bit more specific, right? We mentioned depreciation, but what is depreciation for the listener, and how exactly does that kind of shield income? Because it's a little bit weird and counterintuitive if you don't really know what that concept is.
Yeah. No, it's a really good concept to dive into. So generally speaking, in the normal consumer's mind, I got $2,000 of rent, got a mortgage of $1,500, and then I got a profit of $500. And then come tax time, they're like, all right, cool. I paid $1,500 out, got $500 of profits, so $6K a year. However, they always think that whatever I pay for my mortgage, that's how much I get to deduct. And in the tax world, there's a thing called book to tax differences. So on the books, you made $500 per month. However, on the tax books, there's a difference in terms of, hey, depreciation is actually a further breakdown of your mortgage payment. So depreciation, this is how you can get, so generally speaking, everything's defaulted single family home, 27.5 years. So buy your house, take out your land, divide by 27.5, that's how much you're going to get equivalently. Similar to a 30-year mortgage. So it's pretty close, right? 27.5 years, 30 years. However, on the tax side, depreciation is a non-cash expense. So it's not real money that you have to spend in order to get the deduction, unlike everything else in the world. What other non-cash expenses can there be? There's phantom income if you have, instead of stock options, if you're in tech. That's the opposite. So we're talking deductions here. So what you can do, though, is you can accelerate a lot of that depreciation. So instead of dividing by 27.5 years, can you divide more? 5 years, 7 year, 15 year. So that's going to speed it up. And then you layer in bonus depreciation. You can take the whole shebang. Well, 60% as of today, as of right now, until they pass it. Pray to God they pass it and goes back to 100%.
Yeah.
But it's just saying, hey, let's just take an example, 500K home, and you have 100K of land value. So you have 400K as your depreciable basis. So if you have 400K divided by 27.5, pretty slow. But if you have, you can strip down that 400K through a cost segregation study. Say $100,000 of that is considered 5-year property. Now you can take either $20,000 in year one, or you can take the whole shebang, or 60% as of today, and then take $60,000 instead. But say, for example, you paid, barely anything down. You paid, total 40%, 40 grand down on the property. So the big thing is that you can speed up, and it's always a rob Peter, pay Paul type of game. So you have to pay Paul one day. Don't get me wrong. It's just, we're just robbing Peter for a very, very, very long time. So the big part is that, big part on STRs is that 500K home, generally speaking, you'll probably see about 80K of a tax, extra depreciation. 80K times 30% is about 24 grand. So more or less all your furnishings just came in for free, especially in the STR space. So all you're out is really your down payment, 500K times two was 100 grand. So you're 100K out, and then hopefully it's cash flowing a lot more, but you're going to get such a big tax refund on it. So depreciation, how you use it, you can use it, number 1, straight line, number 2, accelerated, or number 3, bonus. So those are your big 3 things on why depreciation matters, because it's a non-cash expense that you can manipulate so hard into making yourself look extremely poor and pay, relatively, low to zero taxes, depending on what status you have, which loopholes are you using. But it's just money you don't have to spend to get a tax benefit at the end of the day.
Yeah, absolutely. And this is one of the concepts I think is just really difficult to understand, because it is very counterintuitive to have a non-cash expense. So just to kind of emphasize again what Tony's saying, your house is not depreciating in value the way that it kind of sounds. When you think in depreciation, you're like, oh, my house is not depreciating though. It's going up in value every single year. So how am I having this non-cash expense? No, that's just the rules, right? The government is saying you have a physical building, a physical structure, and physical structures, eventually wear and tear over time. And that is an expense you get to book. but it's a non-cash expense that you get to deduct against real earnings. So even though on paper, like Tony was saying, you're making that cash flow, if you're shielding it under this non-cash expense to the government, to the IRS, it looks like you didn't make that money at all. And then, like Tony said, you can get a little bit more advanced with how you use that with the bonus depreciation. So let's double click into that. Tony, can we talk about the short-term rental tax loophole and how you actually take advantage of that as a high-earning W-2 worker? Because typically, right, Tony, if you are a high W-2 earner, you're pretty limited in what you can use in terms of real estate to offset your W-2 in terms of the tax deductions that you can actually use. But there is a way through the short-term rental tax loophole. Can you talk a little bit about that?
Yeah. So high W-2, this is like one of the few things you can do. So like when you're W-2, like one hand's tied behind your back, this is like one of the few like rabbits you can pull out from the hat that are legal. So short-term rental loophole is essentially, it goes back, I think it's like 1980s code, 1986. I think that's when tax reform happened. And it changed how bed and breakfasts worked. So by nature, by definition, all rental income is considered passive, and passive losses cannot offset active income. So how can you make your real estate active is the name of the game. So part of the code changes is that if you're running a bed and breakfast, so if your average stay is 7 days or less, so if you just have total days divided by total stays, so you can have like a couple 30-day stays and then probably just have a 31-day stays or 2-day stays. As long as that number is 7 or less, they see that as, hey, people are leaving, going in, out of your property. Seems like a bed and breakfast. And then number 2 is that you actually have to work at it. So there's like 7 different prongs. Most people either meet the 100 hours and no one else works more than you. So essentially you do everything. Or 500 hours and someone else can work more than you, aka you have a property manager. First one you can't, second one you can. And then there's this third gray one that says you substantially performed all services. But there's not an hour part. But you have to just showcase that. So now that they see that you're actually working on the property, now it's called considered active. So the short-term rental loophole, what it allows you to do is that, Airbnb, those stays are going to probably average out 7 or less anyways. You're going to go there, clean it, talk to all your guests, actually do the real work. You actually have to do the work. And then what it's going to do is going to change that default passive to now active. And in year 1, there's just so much cost from furnishings to setting it up to, you're buying it. And then you can use bonus depreciation on it. So like on that 500K example, you buy a house for 500K and you accelerate 80% or 60% as of now. I'm just going to pray to God it goes 100. But you get, a big, large benefit, looking from 60 to $80,000 of accelerated depreciation. And then that will actually reduce your W-2. So for example, if I rewind and cheat, go back to 2022, had someone in the Bay, made 205 as W-2. Pretty standard, right? After RSUs in the Bay at this rate, which is sad, right? 205 anywhere else in America is like, Jesus, give me that. 205, and then their STR, because of still 100% bonus depreciation, and they made improvements. Improvements are better because you get to fast track that. Then they picked up like a 215K loss. So they paid 0 in income taxes that year, got about 20 something grand refund. So that's kind of just how powerful it can be, especially once it goes back to 100%, or pray, knock on wood, it does. So 200K made paid nothing on the federal level. State, of course, they got killed, still. California's California, they're going to get their money no matter what. So they still paid, 15, 20 grand on state side though.
Guys, this person made over $200,000 in salary, W-2 salary in the Bay Area, California. They did bonus depreciation, accelerated depreciation on their one short-term rental, claimed a $215,000 loss that because of a legal tax loophole, I think loophole is even the wrong word because it's legal to do this. They're wiping out their federal tax liability entirely, where they otherwise would have paid more than 30%. So, so this is insane. This is insane. And this is exactly why I'm going to do SDRs this year. Well, I don't know, Tony. Maybe I should wait, right, for bonus depreciation to come back to 100%. Well, on that note, Tony, can you do a cost seg at any point in time? What if you own the property for a few years and you're just doing standard kind of depreciation, but then you then were like, I learned about this. So like, can you do a cost seg at any point in time? How does that work?
Yeah. So the cost segregation study, you can do it whenever you want. It's generally, I'd say, number one, if you're doing a short-term rental loophole, do it that same year, just so you get your tax benefit. Dollar today is worth more than $1 tomorrow. Or if you just learned about it and you've been operating like this for a couple of years, that's fine. You can still do a cost seg, say your year 3 of operating your Airbnb. Then you just have to do a change of accounting method. And this is a little bit more paperwork. It's kind of a headache, but you're still, just shove it to your CPA. It's not your work. It's not your job. So that's totally fine. Or the year that you quit your W-2 and turn real estate professional. There is one, this is new, and there's some creative folks out there for sure. So COVID happened, right? Remote work. Let's be honest, no one works. Like the real 40, right? You just show up, talk to your coworkers for an hour, go get the free food and the snacks for an hour, maybe work 6 hours, and then half of those are not real hours.
I think you're being generous. You're being generous with that, Tony.
Yeah. Yeah. So remote work happened, and we all seen the articles about the overemployed, right? Where you go get 2, 3, 4 W-2s just because you don't have that much real work at your day job. So I've had some creative folks where they are W-2 and they're like, hey, can I take the real estate professional angle? And I'm like, well, the rules are, over 50% of your time, more than 750 hours in the trades or businesses. And I was like, you can probably do 750 hours because people are willing to work, but generally most people always fail on the over 50% of your time. And the dude actually doesn't work like that much during his W-2. I'm like, hey, whatever floats your boat. And then, so we're going to attack the angle of taking him as real estate professional status. Of course, we have the full logs to support this. We're not taking any like frivolous positions because the data shows it. So I'm like, all right, cool. Like log how much you worked at your W-2, logged how much you worked at your rentals, and a single person too. So generally you always fail on real estate professional status. But yeah, ever since COVID, it's a different approach to doing taxes, since some jobs actually you don't work, 20, 80 hours. You work apparently, less than, 10, 40 hours or something.
Yeah. So you kind of mentioned something, but I want to talk about it a little bit more specifically. So can you talk more deeply about reps or real estate professional status and why that kind of affords you you're just viewed differently in the terms of the IRS and the flexibility that you kind of have with the real estate professional status? And I'm sure Mike knows pretty well as well, being a real estate professional. But yeah, why don't we go a little deeper on that?
Yeah. So the short-term rental loophole is the ugly duckling of real estate professional status. So short-term rental loophole is great. W-2, I don't got that much time. I still want some tax benefits. However, if you upgrade into real estate professional status, so this is like a tax status that you can get, and I say it's like the unicorn of all statuses. So you have this unicorn, and there's a lot of hoops you have to jump through in order to get the status. So essentially what it is that it allows you, like I said earlier, was that all real estate rental activities are considered passive. And one of the ways to unlock it was short-term rental. Number 2 is through real estate professional status. So now you can turn all your losses that were stuck in the passive piggy bank into active losses. And how do you get it? It's that you work over 750 hours in trades or businesses in real estate. There's about 12 of them defined. More likely than not, most people always meet either rentals, operations, brokering, being an agent. So you're actually working the development. That's another common one. Those are your big ones. And you have to do at least 750 hours in those. Then you have to have over 50% of your time in those trades or businesses. So, it has to be, you can't be working a W-2, or I can't be just talking about real estate and taxes all day and be considered a real estate professional status, because my trade or business is being a CPA and tax is not, talking about real estate, those activities. So those are the first 2 hoops you have to jump through. So now you're considered active because you're working over 750 hours. It's your primary craft. And then this is where most people get hung up on, is they think, oh, I got 750 hours, I'm clear. It's not. So now you have to show material participation, and it has to be material participating in what you want to offset. Keyword, what you want to offset, is because you don't want, I mean, there's no point in 500 hours in you being an agent. There's no losses, right? But 500 hours in rentals, that's where everyone's activities are. So you have to do 500 hours in your rental properties, because that's where all that passive income, passive losses are that you need to flip around. So you have to do 500 hours per property, but how you bypass that is you make a grouping election. So say you have 7 properties, you work just a hair bit over 100 hours on each property per year, then, or 5 properties, I guess, because 5 properties, sorry, and then do 100 hours per property. You can make a grouping election, and how the IRS sees that is it's all squished into one activity now. So now you finally met that hoop. All the losses from your real estate will offset whatever trade or business that you were doing personally, and then offset your spouse's income also, generally W-2. So we always see it's one person's usually like, hey, W-2, hold down the anchor. And then the other person's just a real estate professional grabbing and investing into all these deals to offset all the income. Or it's like, one person owns and operates a business, the other person's a real estate professional. So that's generally how you can really take advantage of the tax code. And this is how you really pay nothing in taxes. It's, because all your activities now grouped together. So that's like what, the big guys, big real estate folks are doing here. And it's just how you play the game.
Absolutely. Absolutely. I haven't told you this, Tony, but I'm getting my real estate license here in California.
Nice.
I'm going to have to try to get more strategic about how we do this, especially if my wife keeps her W-2 job. And so I need to figure that out with you. But yeah, no. So just for you folks, there are levels to this game. There are levels to the tax game, and you need a coach, a guide, an advisor like Tony to kind of shepherd you through the different levels of the tax game. But once you start playing the game at a high level, it starts to get really fun, and taxes don't get really boring anymore. And that's what we're trying to kind of impart on you today. So we have a little bit more time, Tony. Let's do kind of like a fire round just so we can kind of get through some more tax terminology that people maybe not have heard of before. So can you just real quickly explain the 1031 exchange and what's all the considerations for that from kind of a tax perspective?
Yeah, so 1031 exchange, it's just section 1031 of the tax code. And simply put, it is just trading your property for a different one that's like similar, like kind. It's a like kind exchange. So you can trade a single family home for multifamily, or you trade a multifamily for a couple single families, or multifamily into commercial, like kind. Generally, it's always the same, right? 4 walls and a roof, generally speaking. So when you're trading, and what the code's written again for is that if you trade your property up for a bigger, better one, or just more or less expensive than your current one, all the taxes get deferred and you don't have to pay the taxes now. So say we're in the Bay, grandma had a house for 100K back in the day, and then she wants to sell it and not pay the capital gains. It's worth $1 million. So we have 900K of capital gains to defer. So then she can go do a 1031 exchange and buy either $1 million property or like 4 properties at $250,000. As long as they reinvest the full amount, they won't be taxed on any of that 900K of capital gains. So that's a way to defer your taxes. And it's always the big way. So you did your STR, took a lot of depreciation. Now you want to sell it. You don't want to pay back the recapture on it. So you can do a 1031 exchange, go find a different property. And generally speaking, how, generational wealth builds is that you either keep the property or you 1031 it, and then whoever holds it, they pass, and then the full step up basis comes to that person. So in the example, grandma sold the house, 100K. She bought for 100, sold and bought $1 million worth of property. The basis in those properties is still 100K. It's not $1 million. But when she passes and gives it to, favorite grandchild, it's going to be at $1 million. So you pay $0 in capital gains. So that's when, hey, taxes and death can finally work together.
Yeah. So this is when I learned this, I thought, wow, because you have to understand, everyone, for depreciation, for 1031 exchanges, for all this stuff, you're kind of just kicking the tax liability down the road, so to speak. But this, when you just literally inherit the property, or, you know, you pass it down to your heirs, then they're inheriting it at that new basis. And then the tax liability is gone, which mind blowing to me. And so this is another level to the game where the wealthy people are not only deferring and kicking the tax liability down the road, they are just evaporating it at the end and doing a massive benefit to future generations. And this is just stuff that normal people don't know. Why would you know this? You have no idea about any of this stuff unless you have someone like Tony. So this one was just like, that one was just mind blowing to me that people are actually doing this.
1031s for the win.
The other thing too, for those listening on 1031, if you pay off debt, an important piece, you have to acquire new debt as well, in the amount that you paid off. So I've done a 1031 a couple times. So the other thing we'll throw out too is why the 1031 can be so powerful. You know, Tony, you said, hey, grandma bought the house for $100K. She sells it for $1 million. Then she acquires $1 million in property. Well, what you could do is leverage it then, right? Even if she owned it free and clear, you could take that $1 million and buy a $2 million building with 50% loan to value. And then you're like, wow, that's where, you know, that's where it can become very, very powerful, especially for when you're selling something that, you know, you've had huge, you know, appreciation on, and then you take it and you multiply it. Basically, it's like, you know, giving the gremlins water after midnight. So I might be too old. That reference might be too old for you young.
No,
for you young.
I love
Anyways.
gremlins. That was great. I didn't know we were gonna work in a gremlin analogy.
I have a question. Can I throw it out? Because I get this a lot when I'm consulting with people, Tony. So people always ask me about LLC, having a property in the name of an LLC and versus their personal name. And you know, to me, it doesn't really matter from a tax perspective, right? Or does it matter?
Yeah, exactly. Not from income tax perspective, it does not matter. So they always think you need an LLC to write off your expenses. It's like, no, you get them no matter what on your Schedule E. So not always needed, but you know, asset protection, definitely you should consider it if you have some assets at play here. But it's always, I tell people, what's your risk tolerance? Do you go to Vegas every weekend, or you just, you know, don't? Yeah.
Right. Yeah. That's just a question I get quite a bit. And I, you know, try to explain it to people, and then you get those weird looks and you're like, okay.
No, that was a good one, Mike. That was a good one. I have a question as well. If you are trying to execute on the short-term rental tax loophole, what if you have a partner that you, or a business partner that you bought that short-term rental with? Like, how does that work in terms of like executing on the loophole, and you're trying to make that work? Does one person exclusively have to take the benefit there, or how does that work, Tony?
Yeah. So the only way that, so generally speaking, it'll just be one person that gets the benefit.
Yeah.
So that's general rule. However, if this property was like massive and you both worked 500 hours or more on the property, that's legit a part-time job between two people, 1,000 hours in a year, you both would get the benefit, but I've not seen that yet to this day. So generally, I just see one person take the benefit, and then, you know, there's always some, you know, agreement between them to get that one side deal under the table. You make it happen, but generally speaking, I always say, hey, whoever's got more tax liability, who has more money, you should probably take the benefit. Wink, wink.
100%. Yeah. Tony, so we're coming up on time, and I want to make sure that we kind of stay on schedule here. Quick question for you is, like, how should people think about, if you're the listener, like, when do you actually have to level up your tax game? When should you kind of consult with an actual CPA and not do your own taxes in TurboTax or whatever? Like, what's the right way to kind of think about when you should get to that point?
Yeah, I'd say if you want to measure from an income side, if you're self-employed, probably $70,000 net income as a sole proprietor, that's when you should really tap into a CPA. Before then, there's not a lot of tax savings that you can be really doing with today's tax code. However, if you're W-2, which is probably most of the folks listening in here, I'd say once you kind of go past 150K W-2, then you can really start thinking about, hey, I should probably ask a CPA, because then generally speaking at that level, you're able to get a loan. You probably have some decent, you know, down payment money, and then you can really start getting more complicated with your taxes. So, or if you drain up, have other people that make less than 150K, but they go do an STR, they can still probably need an accountant at that point. So the main reason why is, I think last year I saw that TurboTax does not do bonus depreciation. So you can't go into their software and trigger the bonus depreciation. So some people like hacked it through desktop, or they just gave up and used like a CPA finally. So those are your biggest times. And then that's when you start really thinking about it. If you're 350K W2, there's like many other strategies, especially from the charity side, that you can look into. Investment tax credits are very big. So if you have that much disposable income, but those are your general rule of thumbs. Or if you're just like, dude, I don't got, time to go learn all this crap and I don't want to, pay so much in taxes, probably just reach out to have a consultation and see, hey, what can help you out at this point? It always really depends on what you want to do in the future.
Yep. And Tony, if the listener has, really enjoyed this conversation and they're getting really excited about taxes and they want to work with the CPA Dude, how should people get in touch with you and what can they expect working with you?
Oh, yeah, definitely. So yeah, on our website, thecpadude.com, that's the best place to just go in, learn about how we work, and it'll like lead you through overall the process and whatnot. And then you'll be able to schedule a discovery call with the team, and then you'll see, hey, if it's going to be a right fit or not. Bit picky on, who we can help and who we can't. Sometimes if it's just not the right fit, we'll let you know. Just don't want to waste anyone's time. It's just like, hey, you got to transition all this knowledge. It's like dating. Like, do you want to tell everyone the same old stuff? Hey, I'm, just 27 years old. I live at 123 Park Street. Like, so that's the big thing. So check our website, socials, the CPA Dude all on that side. Instagram, TikTok's like we're most active on. And then overall process is, we've kind of really ironed out the best path for folks is, year one, we're either forcing folks into the full tax plan in itself, unless they know what they're exactly doing. We'll just do the tax compliance. Or we do have like a private community where like, hey, it's a group setting. It's a lot more affordable, but you can still get a lot of advice. So I go in there weekly office hours and I'll just, when I got questions, I just answer it. So instead of like charging for a consult. So that's a great way to get it. And then, once we get folks' tax plan, we draw up a full customized tax plan per their situation, see what they want to do in the next 12 to 24 months and draft that up. And then they'll sync up with our advisors every quarter. So taxes and your situation should change. If not, there should be a more deeper discussion on why aren't we, moving steps forward in life. So a lot of it's like accountability and coaching on top of it. So every quarter we'll reiterate your tax plan and then calculate your, quarterly taxes, pay that in, and then just making sure that all things that we drew up are being met to plan. And then in between, of course, tax filing plus, the actual, filing the returns, preparation is what we do. So that full process. And then we always know that a lot of people have questions. So it's always, hey, got questions. So we have our secure portal where it's set up where you can just ask questions away and then get those answers back to you, just because Google and ChatGPT aren't the best yet. Tried it myself. I was just like, oh, they got like a joint tenancy and tenants in common wrong. So I ran it through ChatGPT just to test it, and it was wrong. I was like, oh, dear God. Like, I hope no one's using this right now.
Oh, man. Tony, we're at time. We're going to let you go. Thank you so much for all of the value that you have given to our audience. Ladies and gentlemen, if you want to level up your tax game, you need to reach out to the CPA Dude and his team. You will not regret it. I am Jacob Sandoval. You can find me on all socials at Cashflow Saga. He is Mike Magno. You can find him on all socials at Realtor Michael Magno. This has been a fire episode. We will see you guys for the next one. Peace.
Take care.